Welcome to the deep dive. Today we're tackling a really interesting angle on the stock market, something called forced buying.
Hmm.
You're looking to get a solid understanding of how the market works, and fast we get it, and that's exactly what we aim to deliver here.
Absolutely.
Our roadmap for this dive is an analysis from mapsignals.com. The piece is by Lucas Downey, dated May 1st, 2025.
Right.
And what really grabbed our attention, and probably yours too, is this noticeable shift we've seen lately, a solid run of green days.
Yeah, 7 days straight.
Exactly. 7 days after what felt like a pretty bumpy ride just before that.
Definitely felt whippy.
So the central puzzle we're really digging into today is
Mhm.
what exactly is this first buying thing, and, well, what actually kicks it off?
It's a key dynamic, yeah.
Yeah.
And to really get to the heart of forced buying, I think we first need to revisit just how much the market was swinging around back in April 2025. Downey really sets the scene there.
Okay.
Think about that sharp Liberation Day drop.
Mhm.
The S&P 500 took a, pretty big hit, like 10.5% in just
Yeah.
a couple of days.
Oof. Yeah, I remember that.
Then, almost right after, we had this huge 9.5% rally, a real face ripper, as they call it.
All right.
The VIX, that market fear gauge,
Yeah.
it closed over 50.
Wow.
And you layer on top of that the escalating trade tensions with China, that death cross pattern popping up in equities.
Which always gets people nervous.
Always.
Mm-hmm.
Plus, concerns about treasuries, government bonds, and yet, at the same time, you had positive AI news coming out from Microsoft and Meta. It was just a period of real whipsaw action.
Yeah, it really felt like the market was just, thrashing around, searching for direction. And Downey makes this point that this kind of intense volatility, this extreme capitulation, he calls it,
Mm-hmm.
that often sets the stage for precisely what we're exploring now, forced buying.
Exactly.
Okay, so let's dig into that a bit more, this capitulation. What does that actually look like in the market?
Well, at its core, capitulation is when investors it's, individual investors reacting emotionally to scary headlines and falling prices.
Mm.
They just decide they've had enough.
Right, throw in the towel.
Throw in the towel, exactly. And they sell off their holdings, often in really large numbers. This forced selling can be quite dramatic.
Okay.
And as the analysis points out, it very often happens right around market bottoms.
Yeah.
But the critical thing to recognize is that this kind of panicked selling usually doesn't last very long. Once most of the people who are going to sell have sold, the market's momentum can just shift.
And that shift, according to this map signals view, is what often leads to those shorter-term upward moves we see, driven by this the subsequent forced buying.
That's the idea.
It's like the intense selling creates an imbalance, almost, and then buying pressure comes in to sort of correct it.
Precisely.
Now, the report mentions these 4 recurring phases of money flow. Where does this idea of forced buying fit into that picture?
Yeah, this 4-phase model is pretty useful, actually.
Mm-hmm.
It helps visualize how market activity can be cyclical. The analysis pinpoints early April 2025 as being phase 4. And this phase is really notable for, well, basically an absence of buyers. And crucially, record levels of capital leaving the market, record outflows.
Wow, record levels. That sounds extreme.
It is. Downey highlights just how rare these extreme outflows actually are. But here's where it gets interesting. This massive selling pressure you see in phase 4 often acts as the catalyst, the spark that ignites phase 1, which is the phase of forced buying. It's almost like a direct reaction to the panic that just happened.
So the selling wave kind of clears the field, if you will, and then the buyers step into that void.
You got it.
Now, this isn't just theory, right? The report uses historical examples. What can looking back tell us?
Exactly. They draw on their big money stock buys and sells chart. It tracks 10 years of daily market flows, which is a lot of data.
10 years, okay.
And they've picked out 13 distinct periods where there were really substantial outflows, big selling waves.
13 of them.
Yeah. And what's insightful is the pattern that pops out. Historically, when you see this kind of heavy selling, when the mood is just get out of stocks, what Downey calls the crowd dumping stocks.
Mm-hmm.
Going against that, taking the other side and actually buying, has often turned out to be a pretty successful strategy.
That sounds so counterintuitive, doesn't it? Buying when everyone else is, like, running for the exits.
It does.
Yeah.
But the data suggests there's something to it.
Can you walk us through one of those key historical examples? The report mentions the COVID-19 crash in March 2020 specifically.
Yeah, the COVID crash is a really, really clear illustration of this dynamic. Early March 2020, remember, as the potential economic fallout of the pandemic started hitting home.
Oh, yeah. Scary.
We saw just widespread, intense selling, relentless. But that selling did eventually stop. late in March.
Okay.
The analysis points to what they call a quiet period around then, where those huge outflows started to be met by inflows, selling pressure easing, buying picking up.
Right, a sort of balance point.
Kind of. And then what came next was a really strong upward move, this monster green wave of buying, as they put it.
A monster green wave. I like that.
It paints a picture, right? And interestingly, map signals even flagged a marine signal on March 19th, 2020.
A Marines signal. What's that?
Based on their data, it was basically a signal suggesting it was becoming a pretty compelling time to start buying into the market again, like the first troops landing on the beach, maybe.
Huh. Okay, got it. And it wasn't just COVID, right? You mentioned the late 2018 dip showed a similar pattern, too.
Correct. Yeah, the late 2018 pullback, it wasn't quite as dramatic as COVID, obviously, but the underlying sequence was, well, pretty much the same.
How so?
You had a period of significant selling pressure, investors getting nervous, reducing positions, then a stabilization, the selling kind of petered out, and then eventually the forced buying kicked in. It seems to be a recurring market behavior.
Okay, so if we fast forward back to early May 2025, when this analysis came out, the report is drawing a direct line between what happened in early April and these historical patterns we just talked about.
That's the connection they're making.
We saw that sharp capitulation period in April,
Mm-hmm.
and now, or at least back in early May, we were in this phase of light flows where the really intense selling seemed to be getting absorbed by new money coming in.
That's the key argument. They're saying it's likely just a matter of time before this absorption phase transitions into more obvious forced buying, even though, just a few weeks before, back in April's chaos.
Yeah.
That idea might have seemed pretty unthinkable to a lot of investors.
Right. When everyone's panicking, the last thing on their mind is an imminent buying wave.
Exactly.
And the report doesn't just point out these parallels, it backs it up with data, suggesting that the periods after this kind of capitulation can actually be pretty good for investors. What evidence do they show?
Yeah, they looked at all the times in their historical data where they saw more than 600 equity outflows in a single day.
600 outflows. Okay, so serious selling.
Very serious selling, yeah. A sign of significant distress. Their analysis shows that in the months following these high outflow days, stocks, generally large caps, mid caps, small caps, have historically seen pretty substantial gains.
Across the board, then.
Pretty much. And the big market events included in this meltdown analysis are ones you'll definitely remember. The global financial crisis, the European sovereign debt crisis, the U.S. credit rating downgraded, the flash crash, and of course, COVID-19.
So major dislocations.
Major ones. And the crucial takeaway here is that market-beating returns have typically followed these kinds of sell-offs.
Okay, so it's not just about the market bouncing back, but potentially finding significant outperformance.
That's the suggestion, yes.
Now, the report also makes an interesting distinction. It talks about just buying broad market funds versus focusing on specific stocks. What's their take?
Well, they definitely acknowledge that investing in broad market indices, like an S&P 500 ETF, can be a perfectly sound strategy. Nothing wrong with it. But they emphasize that the real opportunity, the great opportunity as they see it, lies in identifying and investing in what they call outlier stocks.
Outlier stocks.
Yeah. These are basically the top-ranked companies that their own map signals process flags as seeing accumulation, meaning big institutional investors are buying them up.
Ah, follow the big money.
Kind of. Their perspective is that new leadership is occurring now in the market, meaning new companies, new sectors are likely emerging to lead the next phase.
Interesting. So post-sell-off, the winners might change.
That's the idea. And for their subscribers, apparently Map Signals shares their specific best names, broken down by industry sectors.
Gotcha.
So the strategy isn't just buy everything during the recovery, but be selective. Focus on where that institutional money seems to be flowing after the washout.
Okay, that makes sense. Find the specific companies benefiting from this potential forced buying wave.
Precisely. Their whole thesis is that understanding this broader market dynamic of forced buying creates a really fertile ground for finding individual companies with strong potential for, above average returns.
Okay, let's try and wrap this up then. What's the main insight, the key thing you think we should take away from this deep dive into forced buying based on the map signals analysis?
I think the core message is pretty straightforward.
Yeah.
These big market declines, the ones marked by that intense selling, that capitulation,
Right.
they often set up the conditions needed for a subsequent period of forced buying.
Right.
It happens as the selling pressure finally fades and new money starts coming back in, looking for deals, looking for stuff that now seems undervalued.
And understanding these recurring patterns, this sort of natural cycle of market sentiment, can give us, you, the listener, a really valuable framework, right?
Yeah.
Especially during those uncertain, volatile times that can feel pretty unsettling.
Exactly. Recognizing these phases can help you, hopefully, maintain a more rational perspective when things get turbulent. And maybe, just maybe, identify some advantageous moments to invest, kind of aligning yourself with that historical tendency for markets to recover and sometimes even grow strongly after these big sell-offs.
Okay. So here's a final thought for you, listening at home or wherever you are, just to chew on. Considering this historical tendency, this pattern of forced buying following major downturns and capitulation, what specific sectors or maybe types of companies do you think might be best positioned to really benefit from this potential phase?
Yeah, that's a million-dollar question, isn't it?
It is definitely worth some more thought and maybe some research on your end as you navigate the market landscape. Thanks for joining us for this deep dive.